The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Karen Cho and Ben Boulos, and these are your headlines. The US government reportedly sends Iran a peace proposal, even as Tehran continues to deny direct negotiations. President Trump says he is optimistic for a deal.
Nobody knows who to talk to, but we're actually talking to the right people, and they want to make a deal so badly. You have no idea how badly they want to make a deal.
Oil prices fall, Brent hovering around the key $100 per barrel level as those reports spur hopes of de-escalation, with futures pointing to a positive open for stocks across Europe and the United States.
Shell CEO Wael Sawan warns that Europe could face fuel shortages as soon as next month as the fallout from war in the Middle East continues. And the CEO of TotalEnergies tells CNBC exclusively that he believes the situation is unprecedented.
The products market, which is the ones which impacts the customers, the end customers today are impacted, is much higher than the Brent. In between, you have the refining margins. The refining margins have never been seen that. They are at $30 per barrel. We never experienced it.
We kick off the day with some data, and this is around UK inflation. And don't forget, we're still looking backwards, not forwards when it comes to the inflation print. Relevant, though, for the starting point as we talk about the impact of the war in Iran and what that will mean for, again, driving inflation further away from that 2% target, which was expected to be hit very shortly by the Bank of England, but nowhere in that range. If you look at the UK February CPI, 3% year over year, so nowhere near the 2% level. This is bang in line with the Reuters poll expecting that we would see a rally to that extent. For the February levels, the CPI rising 0.4% on month. Again, in line with expectations. Looking at the core, that is again high as you strip out energy, food, alcohol, 3.2% year over year. The RPI now at 3.6%. Poll for that was slightly high at 3.7%. Just digging into the producer prices, 1.7% year over year. That is down slightly on the month, minus 0.5%. But worth noting here that it was only just several days back with the Bank of England all moved to the same position. We've had very split vote from the MPC and effectively now all on the same page of waiting it out for more information, 9-0 in the most recent vote. And this, as we see that elevated inflation rate start to cross today.
Nothing to add apart from those producer prices were extraordinary. We were looking for up 2.6. We came in up 1.7 on year, but negative 0.5 on the month compared with a poll of up 0.2%. I'd love to know. Well, I'm going to do a bit of digging, obviously, a bit later on and find out what that is as well, because apart from that, everything was, as you say, pretty much bang in line, backward looking, no use to us whatsoever. That's the only anomaly. I would like to know if there's something extra going on at the moment in terms of those producer prices.
To the starting point, I think starting point matters because we saw that from the Reserve Bank in Australia. The inflation level was at a higher bar. Now you come into another conflict where we know the energy price story is going to have definitely first round effects, maybe second round effects. And some central banks, like the Australian Central Bank, was very quick to move because of that starting point. So again, if you have a 3% handle here as a starting point before you start putting in the energy components and any second round effects, it tells you that a central bank might be more concerned about the outcome here of rising inflation becoming unanchored from expectations.
I'm just going through the producer prices and the largest contribution to the input producer prices was an upward contribution from metals and non-metallic. The largest contribution. Yeah, okay, look, we'll do some more work on
prices, that sort of thing.
I just think it's very interesting considering where prices have gone since.
To your point, there is also an adjustment coming to the inflation level. So there were some changes to the basket that start to get reflected from next month. And that is the addition of hummus that everybody seems to be buying. And also non-alcohol beer was one factor that came into the mix, along with pet grooming. So there's subtle changes on the inflation basket.
Okay, we're going to get a violent reaction on these producer prices next time round, because the largest offsetting downward contribution to annual inflation came from crude oil inputs. The price of inputs of crude fell by 12.6% in the year to February 2026 from a revised fall of 22.6% in the year to January. So those were big downticks affecting the producer prices, and now it's going to be violent to the upside in the next set of figures. Or I'll eat my hat. The US has reportedly sent Iran a 15-point plan to end the conflict as Iranian officials continue to deny direct talks with Washington. The plan, reportedly delivered by Pakistan, covers Iran's nuclear and missile programs and comes ahead of US President Donald Trump's Friday deadline to end the conflict. However, the US is reportedly preparing to deploy thousands more troops to the Middle East, increasing its already large presence in the region, despite President Trump's apparent optimistic tone surrounding the possibility of a deal with Iran. In the Oval Office on Tuesday, the president was asked whether he would send Special Envoy Steve Witkoff and Jared Kushner for direct talks with Tehran.
We're in negotiations, as it turned out, and now you've seen what I said yesterday was exactly correct. We're in negotiations right now. They're doing it along with Marco, JD. We have a number of people doing it. And the other side, I can tell you, they'd like to make a deal. And who wouldn't if you were there? Look, their Navy's gone, their Air Force is gone, their communications are gone. That's the biggest problem. It's very hard to communicate them between themselves.
Well, that's kind of what the Iranians are saying about the Americans. A spokesperson for Iran's military, speaking on state TV, mocked Mr. Trump's claims that Washington is in talks with Tehran, saying the US is negotiating with itself. This as Iran's mission to the UN said non-hostile vessels are allowed now to pass through the Strait of Hormuz on condition there is coordination with Iranian authorities. Dan has been trying to find a way through the fog of war and the fog of rhetoric throughout this entire crisis and joins us again now with the latest. Dan.
Morning to you, Steve. Well, that diplomatic uncertainty is moving oil. Right now, we're seeing WTI fall around 4% as those reports of a 15-point peace proposal outweigh concerns of a further escalation in the region. It seems as if investors are reading this reported US peace framework as evidence that Washington is getting serious about ending this conflict. And the New York Times reports that that plan takes in Iran's nuclear and missile programs, as well as shipping through the Strait of Hormuz as well. But of course, with fundamental questions still unanswered about who exactly the US is talking to on the Iranian side, some analysts are telling us today that this proposal may reflect Washington's ambitions more than active negotiation. Nevertheless, as you mentioned, President Trump really signaling progress in those negotiations, he says, with Iran, telling reporters at the White House overnight that these talks are actively underway and that Tehran does want to make a deal. He also said that Special Envoys Steve Witkoff and Jared Kushner, the Secretary of State Marco Rubio, and Vice President J.D. Vance are all said to be involved. Axios also reporting today that Washington and a group of regional mediators are now discussing the possibility of high-level talks with Iran as soon as Thursday. That would be tomorrow. But of course, we're still waiting for a response from Tehran. And at the same time as well, of course, what's interesting at this juncture for anyone exposed to these markets is that while Trump is talking about diplomacy, the Pentagon is also actively moving in the opposite direction. The Trump administration ordering the Army's 82nd Airborne Division to deploy approximately 2,000 soldiers to the Middle East. We knew already that US Marines were also on their way to the region, really raising the prospect of a potential ground operation as well. But what's interesting right now is that we are in the second of Trump's timeline window here. He has said that he's giving Iran 5 days to reach a deal and he'll refrain from striking Iranian energy assets, at least for now. The question is, what happens when Friday comes and if there is no active negotiation, we don't hear from the Iranians and there's no signs of a deal? Perhaps we could see oil prices rocket back up again. We could see equities sell off. What the messaging coming from the White House is over the next 48 hours is going to be absolutely critical for the direction of the market. And then, of course, you have to remember as well, there are 3 parties involved in this conflict. Right now, Washington is the only active party that is signaling progress on these talks. We haven't heard from the Israelis. They're saying they're going to safeguard their own interest in any peace deal. And of course, the Iranians remain MIA as well. With that, it's back over to you.
Dan, thank you so much for that. Let's look at the wash-up on markets on the back of the geopolitics. WTI Brent this morning, as you can see, flipping lower. We're up more than 4% on both of those trades in session yesterday. So again, reversing that spike is what we're watching. The 89 level on WTI, 100 level still set on that Brent price. When it comes to gold, it was a very slim range to the downside in that trading session yesterday, but you can see we've stepped up and reclaiming the 4,500 plus handle. So that is a bounce for gold, and we've been watching very closely given the bear market territory it's been trading in, the real collapse we've seen in that trading pattern. Silver also stronger today in session, more than 5% is what we're watching in the early trade. To the Asian markets that again digesting the news flow and just what we're talking about here in terms of what appeared to be a Trump taco early in the week, a turnaround in terms of the approach to the Middle East, but many now not sure whether this could be some sort of a stalling tactic as we talk about the potential for boots on the ground, the force now coming through from the Gulf states and their approach to the situation. But at this point, we've got stocks in Asia rising. So again, leaning to the positive, risk on across on Japanese stocks in particular, the strongest in the region, to Shanghai that's up more than 1% along with the South Korean market. European futures early on this morning as we get going. This is the picture we're chasing. Again, modest upside. Markets yesterday were still somewhat cautious. We saw a patch of red around the Xetra DAX in Germany, although we did see appetite for UK stocks up 0.7, the Italian market up 0.8. So pockets of strength across in Europe, but it was by no means one direction, as we saw again a lot of caution over that trading session. To what we're seeing out of the other changes on the foreign exchange markets, the early picture looks like this. So euro dollar is down this morning, as is sterling, so it's still a dollar strength story. We're seeing that versus the Japanese yen up about 0.2%, and also versus the Swissy. So if that is telling you again about the caution has been expressed in some quarters of the market, you are seeing that in that dollar trade. Just a quick look at how US futures are shaping up. Again, we're chasing risk on, so these markets from Asia to Europe also looking firmer this morning. Yesterday, we travelled in a fairly tight range on some of the boards, on the Dow in particular. NASDAQ's where you saw the selling down 0.8, said it was communication services, some of those FANG Plus stocks, the likes of Alphabet, reversing in session.
Something you said a while, just want to spend 1 minute on. You talked about US putting more forces potentially in the region, and we know that the 82nd Airborne is one of the great legendary units of the American Army, and goodness knows, having seen what they did in World War II, just phenomenal. And then you've got the US Marine Corps, which is, again, another phenomenal unit. But this is interesting. My understanding, I've read a lot of military history. I'm no expert, but I've read a lot of military history, including Gulf War I, where people like Norman Schwarzkopf, who was the great general who led the US forces in that, and is a great advocate of overwhelming force. And one of the basics of overwhelming force is using a size of military which is like 3-to-1 to attack. So attacking forces, 3-to-1 to overwhelm defensive. The US military is phenomenal. The USMC, the 82nd Airborne are phenomenal units. But the numbers we're talking about, to overwhelm an Iranian army of conservatively between 600,000 and 700,000 men under arms in a country of 90 million people, I just really, really worry about what this represents. Now, would there be, obviously, trying to take over the whole country? Obviously not. Would they be taking over potentially these islands, including Karg or some coastal regions, which has been talked about? That would seem to be the more logical scenario. But to deploy some of these elite troops in the 5, 10, 15, 20,000 range to take on a country that has an enormous multiple of those numbers of men under arms would seem to me a stunningly dangerous strategy, and would go back to that concern that many have post-Vietnam, post-Iraq, post-Afghanistan about mission creep.
Yeah. What you're talking about is the success of any boots on the ground mission. But is this just, again, another strategy as some sort of negotiating tactic from Trump as he draws up a 15-point plan here to try and negotiate an outcome?
And that is the logical scenario. Put a bit of pressure on. But the other scenario is that there is some people talking in military circles, because I've been listening to a lot of them, that actually the reason why Trump had his 5-day delay was not because he thought there were great negotiations. And again, there's a lot of cloud of that, but it was because that's how long it takes to get these troops to the region. That's
exactly right. So the delay tactic, was it a taco moment early in the week, or was it a delay tactic? Is the negotiation that we're watching quite closely?
Again, I don't pretend to have any professional knowledge of military matters, but have been an avid reader of when it's gone right and when it's gone wrong for militaries in the past.
And to your point, it's two very different scenarios for the market, isn't it? Because we went very risk on at one point in the session early in the week on the market's hope that this was a taco, that it was a real turnaround and that we could be getting to the end of a conflict, versus what we're talking about now, some sort of military operation with boots on the ground, an escalation of sorts before we get to any resolution potentially. That is a very different outcome for markets as we talk about whether this should be risk on or risk off.
Indeed, and all of that uncertainty is, as you've been seeing, creating volatility in markets. But despite that, our next guest says retail investors seem to be staying the course amidst that volatility and are moving money into ETFs and commodities. Carl Hazley is the CEO of Finimize and joins us now. Very good to have you with us, Carl. On a broad level, bigger picture, in this environment, what are retail investors buying and where?
Great question. So we survey them every quarter and have done for the last 5 years to get a sense of where retail investors are investing, how they're feeling about markets. And if you look at this period where they've been dragged from pillar to post by headlines, geopolitics, uncertainty about inflation, interest rates, the overwhelming sense is calm and steadiness, which maybe is surprising. And actually, they're investing more. So 90% say, we're actually going to invest more than we planned or keep to our plans that we had back in January. And as for where, ETFs and commodities, top of the pile. And we've seen this playbook before where it comes to ETFs. When there is volatility, retail investors don't cut and run as they've been accused of doing. What they tend to do is diversify away from single stocks and towards diversified funds, just to, again, lower the beta on their portfolios. And then commodities make sense, I guess, given the geopolitical environment around energy, but also around gold. And granted, that's moved sort of counter to what you might expect given the inflation risk.
It's interesting that, generally speaking, retail investors moving into ETFs and commodities and those assets, when it feels like when the markets have fallen, institutional investors seem to be going more into the dollar specifically and currencies because they're anticipating interest rates staying elevated, perhaps even going up in the short to medium term. So who's positioning correctly? Because they're going in opposite directions.
Yeah, I mean, I don't know if it's necessarily right or wrong. It's more about time horizons. You know, the challenge that typical institutional investors have is no matter, we're in March right now, but come December 31st, or maybe even come March 31st, they've got to report on their quarterly performance. They've got to fundraise, their bonuses and their employment all depends on it. Whereas in a retail investor, March 31st comes and goes, December 31st comes and goes, I'm still invested. I've got the next 20, 30, 40 years to worry about my returns. And so it's more about time horizons. And I think retail investors, can't call the macro any more than, frankly, professional economists at this point. And so they're not trying to, they're just putting money where they know they can over the next 3, 4, 5 years.
And is there a sense that they are looking at that long time horizon? Because you're always told invest for the long term, but we keep seeing these meme trades where people want the excitement of the short gains.
I get you, that's such a small part of the market. I get it's the noisiest part, and so people pay attention to it, but 55% of people we survey trade or update their portfolios quarterly or monthly. Some, maybe 15% set and forget, which you probably don't want to do for too long. But that daily or weekly in and out meme trading thing, it's a fraction.
Oh, come on. We all know the difference between a trader and an investor.
Yeah,
the old adage goes, we're all traders until the trade goes wrong, then we become investors. Done that a few times. Right, okay, let me move on. Crypto.
Yeah.
Dull as ditchwater it appears to be, which is the worst possible thing for all our dear friends in crypto world who only rely on churn. Planned allocations fall to 21%, down from 29.5% last quarter. That is fascinating. Amid all of this talk about safe havens, whether it be the Swissy, whether it be the dollars are safe haven, whether it be gold and silver and the extraordinary excitement we've seen there, no one cares about crypto anymore.
It's interesting. So there's a couple of points, and I don't want to get on my soapbox too much about crypto.
No, but please get on your soapbox. It means I don't have to.
Okay, but look, so crypto was digital gold. It failed. Crypto or Bitcoin was digital gold and it failed. It was.
Well, I've got. Okay. Why did it fail? I agree with you, but why did it fail?
I'll come back to that.
Oh, right. Okay.
It was also an inflation hedge. and it
Yeah,
failed.
didn't work.
It was also a currency,
Nah.
and it failed. Now, there is
Store value? Nah.
but there's probably something there. Okay. We just don't quite know what yet. But for the people who do believe, they are battening down the hatches. 2/3 say that we're either holding or adding at these lows. So there is, again, it's coming down to belief versus non-believers. But you're right, it's tough to get the incremental dollar of interest when crypto, when Bitcoin's price is dominant.
I know Karen will come in a minute, but I wrote a piece on this about a month ago, and it's like, it's boring. People don't care. Do you know, look, they care about Cauchy, they care about Polymarket. By the way, I think CNBC does have a relationship with Cauchy, so I should just clarify that in the United States. And they care about gold, they care about silver, they care about the meme stocks you two were just mentioning about. But honestly, the worst thing possible has happened for crypto is that people are bored of it.
I think that's, if you are a crypto believer, this is kind of the good thing. I think it's
okay.
Because
that's interesting.
Things come in, they get really excited. People get excited. There's a lot of hype. Let's go back 5-10 years, 0% commission trading. Oh, really exciting. Fractional shares. Oh, really exciting. Crypto. Oh, really exciting. And then you sort of wash out. And then if it becomes boring, it kind of becomes a normal portfolio.
Well,
piece.
no, but I'd bring you into like the cuddle. I know it's a completely different thing, but the economic concept of the middle income trap, because you have to get to a certain level in your economic growth before you can actually hit middle income, whereas actually a lot of countries don't get to that level, and which becomes a bit of a trap for them. I would suggest that the critical mass for crypto hasn't been reached for widespread adoption and widespread acceptance, and so they haven't quite made it.
I think that's fair. I wouldn't argue with that necessarily. Okay. I think if you think about like the betting markets, the poly markets, the Cauchys, that's the new fun, exciting thing. When that gets boring, that's probably a good thing. It probably means it's settled and it's a part of how people think about everyday life.
There's been a lot of posting on platforms like X about what happened to the retail trader at a moment like this, because we really haven't seen them come back in and provide a prop for the market in any form. There was a view that, look, these are long-only traders. Whose market going up, then that's when the retail investor gets involved when they see just clear upside or it is moving aggressively to the upside, that these are not traders that short the market, not active on the other side. Now, as we're talking about inflation going up, higher energy prices, you've identified that 55% plan to invest at least 10K this year. Could that be impacted by, again, inflation, cost of living crisis that could return?
So I think there's two things going on. One is, if I rewind just a quarter ago, retail investors said, look, it's tough to find attractive entry points. I'm sitting on cash looking for entry points. We've had some of those entry points, and so we're seeing that cash come to work. I think the other is, if I go back even further and I go back to sort of Russia, Ukraine, when we surveyed investors then, they said, I have money I want to put into markets, but everything is so uncertain, I just don't know what to do. Now, we're nowhere near that at the moment, but ask me again in 24 hours, we could be closer to that. And so there is a risk that money stays on the sidelines, doesn't get invested, if there isn't a clear sort of geopolitical path forward.
Do you also need to see momentum in the Mag 7 stocks for the retail investor to have confidence? Because this is where they've concentrated their portfolio. And we've been talking to fund manager after fund manager that it keeps on saying, I don't like the Mag 7 stocks at this level. That was, of course, before we've come into the conflict in Iran. The obsolescence story has come up around the software names. So do you think all this has just been holding the retail investor back to that specific uncertainty?
Yes and no. At the margin, yes. I think that Mag 7 story, that sort of SaaS-pocalypse story, retail investors will be aware of and pay attention to, but they are not going crazy Mag 7 and only Mag 7. What they tend to do, and what we've seen over the last 6 months, is they say, look, Mag 7's great, AI is great, however, let me try and find the pockets around infrastructure, around energy, around sort of second, third order plays, so that I'm not overly Mag 7. And frankly, everyone owns a slice of S&P 500, and that's so heavy Mag 7 that you probably don't want to double down unless you've got real conviction.
Okay. Carl, thank you very much. Really good to get your thoughts on all of that. Carl Hazley, CEO of Finimize there. Still to come on the show, Denmark's election throws up some surprises with the first moves on coalition formation expected today. Plus, OpenAI says it is closing down its generative AI video app Sora just over a year after it was launched. We will discuss what's prompted the U-turn. And as the UK and Europe brace for an energy price shock, we'll hear from the CEO of EnQuest, Amjad Seysu. That conversation is up next.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
EnQuest has posted a full-year pre-tax profit of just over $493 million. In its release, the UK energy firm said it has so far not seen any material day-to-day disruption caused by the Middle East conflict and closure of the Strait of Hormuz. Amjad Seysu joins us now, the CEO of EnQuest. Amjad, thank you so much for joining us again. We had a great chat the other week as the conflict was kicking off, but I want to get into the numbers with you and what the impact has been, because the reality is when we saw the first half numbers come out, you were facing a low oil price and you were still confronted with the windfall tax here in the UK. Now that you have a high energy price, is that compensating for some of the tax that is really upending a lot of the numbers that you've seen across in the business?
Well, thank you very much for inviting me. It's a pleasure to be with you again. So far the impact hasn't obviously been in the numbers because we're in 4 weeks of higher prices. Last year, the average price, realized price, was $68 a barrel compared to about $80 the year before, so it was a lower price. But we still had an increase in production of about 5.4%. We were at the above the upper end of the range of 45.6 thousand barrels a day. Our range was 40 to 45 last year. This year, we're setting a range of 41 to 45,000. Our EBITDA was about 503 million last year, slightly down on the year before. But more importantly, we entered 3 countries last year, and that is part of our pivot to Asia. So we bought a production asset in Vietnam where we're producing. We have a development asset in Brunei with the government, a joint venture with the government. We also have an asset in Malaysia we took over, which is in Sarawak. And then lastly, we entered Indonesia, where we have an asset with development, but also exploration potential with BP and the Tangguh Alliance. So we're very excited about the pivot to Asia and the production that we see in Asia going up to about 35,000 barrels a day.
So just put that into context, this pivot towards Southeast Asia at a time when we've seen a bottleneck now around the Middle East and energy production. When does that start to translate for you in the business? Is it a short-term impact, a more medium, long-term? How are we thinking about the progression here as you've invested in those assets?
So a third of our production now comes from Asia. We're doing about 50,000 barrels a day, of which just above 15 is coming from Asia. We also put in a project to develop gas in the last 12 months, and that was in Malaysia. We did it very quickly in 9 months, and now we were producing. We sanctioned it in March. We started producing in late December. That was around 60 million standard cubic foot a day. We've increased that actually because of the demand over the last few weeks. We've been asked to increase it, and we've debottlenecked even a new facility, and we're doing upwards of 100 million a day, almost 5% of the supply into Peninsular Malaysia. But the UK still remains a very important part of our assets. It's still our major part of our assets. And again, the hope is the government will pivot to help us invest in the UK again by really just introducing the oil and gas pricing mechanism, which was agreed with the government when the consultations in the past few months.
Amjad, how dumb is the UK government when it comes to fuel policy? A, for the extractors of the product in the North Sea, where it seems their zealots are in charge of our policy, and B, when the Chancellor of the Exchequer accuses the forecourts of price gouging. And I no doubt, to be honest, I have to fill up with diesel when I drive in, so I can see the price increasing aggressively. But it is the government that is making the lion's share of the money from a gallon of petrol on the forecourts as well. some of the numbers are quite staggering. At least 50% of the price paid per litre is made up of tax. The split is between VAT and fuel duty. VAT makes up 17% of the price we pay for both petrol and diesel. The numbers, if you go into it, ladies and gentlemen, are stunning. So on the two aspects, one, the government's accusing the forecourts of price gouging, but actually it's the government that makes more money from a litre of fuel. And two, this adamant response from the Energy Secretary that we cannot have our own source of fuel when it costs more to bring in that LNG and all that fuel from elsewhere around the world.
I mean, I'm violently agreeing with you. Obviously, it's we're exporting jobs and we're exporting energy security. We can see that this is more needed than ever. I think the OGPM, the oil and gas pricing mechanism, should have come in when it was slated to come in by the Chancellor because of this issue. The price at the pump has always been primarily tax. It's been mostly tax for a long time, and that was to reduce actual demand in the UK and in Europe in general. But I think there's no reason why the UK should import gas that's 4 times more, has more emissions than gas produced internally, and oil that's 3 times more carbon intensive than oil that's produced initially. And we've gone from 1 million jobs in the UK to 200,000 jobs. I think actually we've gone as a company from 6,000.
What is wrong with a pragmatic attitude? I've been to a lot of COPs. I'm a great fan of let's get to net zero, but we have to do it pragmatically, and we have to do it with the use of cleaner molecules rather than just electrons. There are estimates, you know this better than I do, there are estimates of remaining oil and gas in the UK North Sea. They vary. Bearing in mind, we're talking about 100 million barrels a day of global oil being used and 20% of that being jammed up in the Strait of Hormuz. There are estimates of 2.9 billion barrels of proven reserves in the UK North Sea. Are we bonkers in the United Kingdom for not trying to extract that?
I think the government should look at that as a very important resource.
Can I ask you, have you had a conversation with Mr. Miliband about this?
We discussed this last time.
I know. I just wondered since then if he's seen the light.
We are very focused on tax because that's really the key for industry, and incentives for industry are the key for us to develop. We have 2 fields, Bressay and Bentley, which have 1 billion barrels of oil in place. We've developed technology which is very unique to Britain, actually very strong British technology to develop heavy oil. We have the heaviest oil produced offshore in the world in Kraken. That can easily be used in these 2 very large fields. We have significant resources there, 400 million barrels of resources ourselves as a company. We don't today look at that as a feasible investment because the fiscal regime today is not conducive to that investment.
I'm struggling with. I struggle with a lot of global policy. We can't give ourselves energy security because of tax. Nothing else. If you had the right tax regime, you would go in there. Others would go in there and extract British-sourced energy to give us energy security. But the only reason you're not doing it is because of tax policy of the UK government.
Absolutely.
I rest my case.
Amjad, last time you were here, I was asking you about your thoughts on the oil price and how much changes day to day, how much changes week to week. What are your assumptions based on in terms of your business planning and decisions? Where do you see it sitting for the medium term?
So this is a macro question, not a macro question. The war impact. Steve mentioned it's 20 million barrels a day that are stuck behind the Straits of Hormuz. It's a Hormuz crisis. It's a choke point crisis. And the short-term impacts, which are weeks to months, is that 20 million, maybe going down to 12 million as Saudi is producing more through the East-West pipeline. But then the medium-term impacts are quite significant. So we have lost production, maybe 2 to 3 million barrels a day of actual refined products that are now not able to be produced because of the damage to for example, the Pearl Shell project, the refineries in UAE, and also the LNG plant, which will take 4 or 5 years in Qatar, with 17% which is 4 or 5% of the world LNG supply. So these longer-term impacts, we think probably around 2 or 3 million barrels a day, and the capacity. The excess capacity, when we had excess capacity in the system, as Steve was mentioning, was about 2 to 3 million barrels a day on 100 million. So I think this excess capacity is gone probably for years. And so the baseline is going to be it will be higher over time. So I think we are going to see that's a secondary impact, which is the loss of this production for a long time, medium to long term, years, months. I mean, the Kuwait Petroleum CEO Sheikh Nawaf said that it's going to be months for Kuwait to start its production. And then the tertiary impact is what you talked about earlier, is the inflation impact. I mean, the IMF has talked about 0.4% reduction increase in inflation for every 10% increase in oil price. So that's a couple of percentage points, taking us up to about 4 or 5%, which will come through again. Again, we're seeing fertilizer prices, food prices going up. So those impacts are going to be quite important. I mean, given the numbers we saw in the UK today, those will be going up.
And I forget which commentator it was, and I apologise to them as I quote them without attributing, but I read that this was the most unforeseen shock to the energy sector. We always knew the Strait of Hormuz was a potential vulnerability, the tensions between Iran and the US. Was the world properly prepared?
I mean, the big issue is once this has taken place, this is the first time the Strait has been closed for this period. This just opens up completely different facts and fact patterns for the future. What will Iran want to do? They are charging vessels to go across. There's only 21 non-Iranian vessels that have kind of crossed the Straits of Hormuz in the last 4 weeks. What does the future look like? I think the future is not clear.
I'll leave it there, Amjad. I don't know if I'm enheartened or not. Look, well done on producing a set of numbers in this crazy environment as well, but quite extraordinary, some of the bottlenecks to more production, certainly in this part of the world. Amjad, lovely to see you. Amjad Bzaizu, who is the CEO of EnQuest.